But sustainability as a theme tends to be, technology opportunities. So if I think about different types of themes, whether it's energy, transport, food and agriculture, buildings and how they need to evolve, waste or water, health and well-being, all of those areas, if we're going to think about a cleaner, greener, healthier future, technology is going to play a critical role in all of those sorts of areas. So I think technology as a theme will be very important for sustainable investors.
Welcome to The Greener Way. I'm your host, Michelle Baltazar, Director of Media here at FS Sustainability. We are recording on Gadigal land and we pay our respects to the traditional custodians of country and elders, past, present, and emerging. Today's guest, Dave Rae, is a financial advisor and co-founder of Unless Financial. He is a certified responsible investment advisor by the Responsible Investment Association Australasia, or RIA, where he previously chaired one of RIA's certification assessment panels and co-chaired RIA's Financial Advisor Forum. Dave, thanks for joining us.
Thanks, Michelle. Great to be with you here from Ngunnawal country in Canberra this morning.
So the question we want to answer by the end of this episode is, what does financial advice look like for climate-conscious investors? What does that look like from a portfolio allocation perspective? And what are the misconceptions around risks and returns when it comes to responsible investing? So, Dave, this must be one of the first questions you get asked by a prospective client. Tell us about your approach to providing financial advice.
Thanks, Michelle. Look, I think when we think about having a sustainable focus on investments for clients, the starting point is to talk to every single client about it. So it's not something that we would wait for a client to raise a particular concern or a particular issue. Every client conversation, we are asking questions and wanting to understand what's important to a particular client. Now, it's just built into the process, so it's just a given. The way that I think I've got a lot of cut through in terms of having the conversation with clients is to use visual cues to, I guess, open up the discussion. The old saying of a picture says 1,000 words is true when you can use some slides to easily and quickly sort of visualize some particular things. I like to focus on the positive more than the negative, and we can sort of talk about that when it comes to an investment focus. But in focusing on the positive areas like, solar panels, more than 4 million households have solar panels now. A lot of people have done that for cost, but a lot of people have also done it because they care about cleaner energy. So that's a really good conversation starter, is just showing a house with solar panels on there. And whether it's things like, the waste problems or sustainable, clothing or countless of examples like that, I find that visual cue is a really good way to engage clients in a conversation. And what I find then is that it's a much deeper conversation, because you are sometimes getting into things that people haven't thought about before, or they haven't thought about it when it comes to their money and their investments. They might have thought about it when it comes to where they work and what they do, or how they volunteer their time, or how they voted an upcoming election. And it can also mean then that deeper conversation sometimes can get a little tricky, because there is an election coming up, and climate maybe is not the number one issue like it seemed to be close to at the last election. Cost of living and housing has come in, but when you sometimes can become a little not that I become political, but the topics of conversation can become a little political. It can be a little bit trickier to navigate. And I think also for advisors, particularly one of the most important conversations we're having is intergenerational wealth. And so we do find that there is a different level of sometimes not necessarily interest, but a starting point for younger generations. Older generations may not necessarily have thought about these things as much. Once you have the conversation, that interest is there. But we're finding that intergenerational conversation means that sometimes it is the younger generation that is the ones who are pushing the conversation to bring that out. So, yeah, and the final point that I just make on that as to how it's different is that if I think about it from an advice perspective, it's really making sure that clients understand that we're not seeking perfection when it comes to this. There are going to be trade-offs. So you might have some particular preferences around where you'd like your money to be invested or not be invested, but we're not seeking to have that match from day one in an exact way and have zero exposure to particular things or much bigger exposures to the more positive areas. But we want to start to move in that direction and understand that we do need to keep the risk and return aspect to that as well, alongside those sustainability preferences.
That's great to know, because I think perfection, it doesn't even exist in the normal world, whether you're climate conscious or not. So to have that discussion early on that there's no such thing as a black or white when it comes to investing. Now, you did mention risks and returns. So with sustainability as a purpose, what are the kind of risk and return profile for your clients? Do they differ much from someone who just approaches, say, a traditional financial advisor?
I'd say the risk return profile or tolerance for risk, if I'm thinking about it in that way, is not too dissimilar to typical clients. It's really using then sustainability as an overlay around how we might then invest that money. But I think there's some interesting ways to raise the conversation of risk and return with clients and bring it to some of the areas they might understand. And I think as investment professionals, for so long, I think the risk return conversation has been very short term focused, and whether that's at the company level in terms of incentives that management might have with their KPIs, or funds when they're focused on monthly and quarterly returns as their sort of key metric. I think what happens with that is that it can come at the expense of the longer term focus. And I think where we look at what happens in the short term, business as usual and risks if we don't change things, versus what happens with a longer term focus and really thinking about the opportunities that can come through investing sustainably, whether that's cleaner, cheaper, or a healthier future around some of those kind of areas. And I think the conversation around risk and return has really moved on from do you have to give up anything to invest in this way? We've seen you mentioned the Responsible Investment Association, their annual benchmarking report has shown year after year that you really don't give up returns by investing in this way. There's countless fund managers, and without calling out their sustainability approach, but Dimensional as an example, I've kept a close eye over a period of time, and their sustainability options are actually performing as well or at the top of their Australian equity and global equity funds. So I think that conversation has moved on from there.
So in terms of returns, definitely countless research saying that you don't give up the returns to invest in a way that is responsible and also very much forward-looking, which is what you're looking at if you're climate conscious. But what are the other misconceptions around ethical financial advice?
The one thing that I'd probably just add to what I've just mentioned is that I do find that returns misconception can still be around, but I think given the evidence that I've just mentioned there, I do find that a bit of a lazy one. And I think that's where it can come into another misconception, is that it's a lot more work, or too much work, I should say, because it is more work if you want to invest this way. It's another element to add to thinking about risk return. It's thinking about that sustainability or ethical or impact, whatever label we want to put on it, is understanding the different approach of funds there. So I think a misconception that it's too much work, though. Investing is a lot of work. It's not a simple thing to just look at a set of alternative ways or options to invest your money and pick something out. It does take work to understand what you're investing in, what the strategy is. So if you want to add that sustainability element to it, it's just adding to understanding, the strategy there. So I don't think it's too much work. It's just an additional aspect to consider. And personally, I find it fascinating. I find it really interesting to get into it and look at this way of investing.
Definitely. It's just a different approach. I mean, even if you look at emerging markets, that would be more work than, say, looking at developed markets and their businesses. A little tidbit about you that I was just checking earlier before this podcast is that you did work as an accountant for a couple of years, and you did work as a quant analyst for an investment bank, quant analysis of Aussie equities, I believe, and also accounting. So you are a numbers guy when you first started, and now financial advice. So there's purpose there as well. But are there enough Australian companies to invest in, or would a sustainable portfolio look more global?
In the main, it depends how deep you want to go on your sustainability and impact. And I think, as an example, North Star is the only RIA certified impact public equities fund in Australia with impact in its name. It's predominantly a small cap fund, so it really does narrow the focus there. So if you want to be investing really with a strong sustainability or impact focus, then it is going to mean that to get your diversification, you're going to have to open up to global investment opportunities.
Speaking of global opportunities, what's your take on tech companies and where the investment opportunities lie, especially because the mega trend is that we will be looking at a lot of tech-based stocks in either Aussie or global portfolios?
I think for sustainable investors, there's a lot of opportunity in technology. We like to think that technology improves our lives and makes the world a better place, but then we also then end up with some companies like, Meta and Facebook and what that's done from a social media perspective, or Tesla, which a lot of sustainable investors were fans of some time ago, but with a whole lot of, governance issues, maybe not so much anymore. But sustainability as a theme tends to be, technology opportunities. So if I think about different types of themes, whether it's energy, transport, food and agriculture, buildings and how they need to evolve, waste or water, health and well-being, all of those areas, if we're going to think about a cleaner, greener, healthier future, technology is going to play a critical role in all of those sorts of areas. So I think technology as a theme will be very important for sustainable investors.
So do you feel like there would be like an overweight into tech stocks, or it truly depends on the individual portfolios of your clients?
Yeah, look, I think in the main, there's going to be a more of a weighting to technology stocks, just because of all of those sustainability areas that I mentioned do tend to have, it's technology companies that are sort of driving that change for the future that we need to see.
Well, I know that it's just the tip of the iceberg. Everything that we've talked about, we haven't even looked at all the different aspects of ESG, governance, the social aspect. But truly, for your business, it's very specific. It's for climate conscious investors. Anything else you'd like us to cover?
Look, the last thing I'd mention around that is that, we started this business because we do feel the urgency, and, we're halfway through this critical decade. We've only got to look at what's been happening recently. Scientists have been warning for some time that, we're going to see more extreme weather events. So, Cyclone Alfred, right at the moment, we've got historic, a flood disaster in Western Queensland, and not long after the fires in LA. We've got to think about what that means for the effects of the effects on that in our portfolios. how we're going to try and mitigate, what's happening with these natural disasters, how we're going to adapt to climate change. So whether it's insurers and what that means for their business, or thinking about the buildings in which we work and live, and how they're going to cope with a hotter world. There's a lot of impacts for portfolios beyond just the headlines of, I think, energy has been such a big focus of the conversations around, fossil fuels versus renewables. But, this goes far beyond that to so many aspects of portfolios. So just wanted to leave that as a final point to think around the risks and opportunities that already sit in portfolios, and how we need to move them for, what the future holds.
Well said. Dave, thank you so much for joining us. We'll probably leave it there, but we'll have a part 2.
Fantastic. Thanks, Michelle.
This is The Greener Way. I'm your host, Michelle Baltazar. Thank you for listening.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.